imagine unlocking investment opportunities, the kind previously reserved just for the ultra-wealthy. We're talking about a recent executive order that aims to do exactly that for your 401k. It promises brand new paths to growth for your retirement savings. We're going to dive deep into what this historic shift could really mean for your financial future.
Yeah, this move absolutely signals a significant transformation. We could be looking at opening up a slice of, an estimated $12 trillion in defined contribution plan assets to a whole new world of alternative investment.
12 trillion. Wow.
But here's the crucial question, right? What if those new paths, while they sound promising, also lead to unforeseen risks? We're talking potentially higher fees, maybe less control over your own hard-earned retirement savings. It definitely raises some really important questions for, every American planning for their future. It's a tension we really need to explore today.
That's precisely what we're going to explore in this deep dive. We'll look at the arguments for expanding access, define the specific, often pretty complex types of investments involved. Yeah. We'll also trace the regulatory journey, which is fascinating, that led us here. And of course, dissect the big concerns critics are raising.
Yeah.
Our mission really is to distill the key nuggets of knowledge you need to be well-informed, to help you understand the real implications of this potentially monumental shift.
Okay, so let's unpack this a bit. What's the core problem this executive order is trying to solve, according to the people backing it? Why now?
Okay, so the primary purpose of this executive order, which was signed by President Trump back on August 7th, 2025, is really to address what proponents see as a fundamental imbalance in investment access. See, for a long time, wealthy Americans and also government workers and public pension plans, they've had access to these alternative assets. They've enjoyed potential growth, diversification opportunities.
Stuff the rest of us couldn't really touch. Exactly, but the vast majority, we're talking over 90 million Americans in employer-sponsored defined contribution plans like 401k, they just haven't had that same chance. The administration argues that things like, quote, burdensome lawsuits and stifling Department of Labor guidance stuff issued since 2020 have essentially denied millions of Americans opportunities to benefit from these types of investments. So the stated policy objective is pretty clear. Every American preparing for retirement should have access to funds that include investments in alternative assets, provided a fiduciary, someone legally bound to act in your best interest, deems it appropriate.
Okay.
And let's be honest here, this also opens up a huge new market for alternative asset managers. I mean, defined contribution plans hold over $12 trillion in assets. That's a massive capital pool these managers have been, very eager to tap into.
So it really sounds like it boils down to leveling the playing field, giving average investors a shot at where maybe the real growth is happening now, especially with companies staying private longer.
Precisely. For decades, the public markets, stocks you could buy, that's where companies grew and created wealth for average investors.
Yeah.
But now you see a lot of innovative companies delaying their IPOs, their initial public offerings. They're raising massive amounts of capital privately. So the biggest gains are often made before a company even hits the stock market.
Before we even get a chance, basically.
Right. Proponents argue this order aims to bridge that gap, give 401k participants a seat at that table, or, at least a slice of it. They suggest these alternatives can offer protection from market swings and the potential for outsized returns, which they see as critical for long-term returns, especially in today's rapidly changing market environment.
Okay, that sounds really compelling. But what exactly are we talking about when we say alternative assets? It sounds like a broad term. It's not just private equity, is it?
Oh, no, it's far broader than just private equity. The executive order itself explicitly defines alternative assets. It includes several distinct categories. First, you've got private market investments. This covers direct and indirect stakes in things like equity, debt, other financial instruments that are not traded on public exchanges. Think like private equity itself, investing in private companies, or private credit, which is direct lending to companies.
Okay, so stuff not on the stock market. Got it.
Right. Then there's real estate. That covers both direct ownership and indirect interests, like, say, debt instruments secured by real estate. So not just owning a building, but maybe investing in the mortgages on buildings, too. The definition also includes digital assets. Specifically, it mentions holdings in actively managed investment vehicles that invest in cryptocurrencies.
Okay, so it's not like you're buying Bitcoin directly in your 401k.
Exactly. It's more like investing in a fund that manages crypto investments for you. That's an important distinction.
Right. So private companies, buildings, crypto funds.
Yeah.
What else is on the list? It seems like a lot.
Yeah. It is quite a list. It also explicitly includes commodities. Think direct or indirect investments in things like gold, oil, maybe agricultural products. Then there's infrastructure development, so investing directly or indirectly in projects financing things like roads, bridges, utilities, that sort of thing. And finally, it includes lifetime income investment strategies, things like longevity risk-sharing pools.
Longevity risk. What does that mean in plain English?
Basically, strategies designed to help generate a steady income stream you can't outlive, sort of like creating your own pension payout, often by pooling risk with other investors.
Okay.
So as you can hear, it's a really diverse group of non-traditional investments, way beyond what most people currently think of when they look at their 401k statement.
Definitely. We're talking about a truly diverse range here, far beyond just stocks and bonds. But, bringing assets this complex and often illiquid into something as fundamental as a 401k. There must be a backstory here. What's the regulatory journey been like? It feels like this isn't just a sudden change.
Oh, absolutely not. There's quite a history. The foundation for all this is the Employee Retirement Income Security Act of 1974, ERISA. That's the law requiring fiduciaries, the people managing your plan, to invest prudently, putting your interests first.
Right. Prudence is key.
Exactly. And for decades, partly because of that prudent standard and concerns about complexity and risk, 401ks mostly stuck to traditional liquid assets like stocks and bonds. We saw a pretty significant step, though, back in June 2020. This was during the first Trump administration. The Department of Labor, the DOL, issued what's called an information letter.
Okay.
And it clarified a really crucial point, that plan fiduciaries would not automatically violate ERISA just by including private equity within a professionally managed diversified 401k option.
So kind of opening the door crack.
Kind of. It was seen as a positive step, signaling maybe more openness than before as long as certain factors were considered. However, under the Biden administration that followed, the DOL, it shifted its tone quite a bit. In December 2021, they issued a supplemental private equity statement.
Supplemental. What did that add?
Well, it didn't fundamentally change the rules, but it adopted a much more cautious stance. It really emphasized that plan fiduciaries might not have the expertise to properly evaluate private equity. It suggested they might need third-party advisors. And this statement is widely seen as having chilled the momentum. It sort of put the brakes on what the previous administration had seemed to encourage.
Okay, so a definite regulatory pendulum swing there. What about crypto? That seems even more, volatile.
Yeah, the guidance on crypto saw a similar kind of back and forth. In March 2022, the DOL expressed, quote, serious concern about putting crypto in 401ks. They cited volatility, valuation problems, potential for fraud. Pretty strong warnings.
Understandable concerns, I guess.
Right. But then earlier this year, in 2025, the DOL actually rescinded that guidance. They went back to what they called their historical approach. Which basically means they neither endorse nor disapprove of crypto specifically. Instead, they just emphasize the standard fiduciary principles, evaluating any investment based on its specific merits and risks in the context of the whole plan. It's less of a no and more of a, well, you can, but you better be really careful and document everything.
Got it. So after all that back and forth, almost like whiplash, now we have this new executive order. It sounds like it's directly targeting that caution, especially the 2021 statement. What exactly is it telling the DOL and the SEC to do?
Precisely. This new executive order from President Trump is very direct. It specifically tells the Secretary of Labor to re-examine past and present guidance. And it particularly mentions considering rescinding that December 2021 supplemental private equity statement, the one that chilled momentum.
Taking the chill off, then.
Trying to, yes. The DO is also tasked with clarifying its overall position on alternative assets. This includes setting criteria for fiduciaries to, and I'm quoting here, prudently balance potentially higher expenses against the objectives of seeking greater long-term net returns and broader diversification. And it tells them to propose new rules or guidance. Crucially, this guidance may include appropriately calibrated safe harbors.
Safe harbors, meaning ways to reduce the legal risk for plan sponsors if they offer these.
Exactly. Ways to make it less likely they'll get sued under ERISA if they follow the rules and offer these alternative options prudently. And it doesn't start with the Department of Labor. The order also instructs the Securities and Exchange Commission, the SEC, to explore ways to facilitate access to.
How so?
It even suggests considering revisions to existing SEC regulations and guidance relating to accredited investor and qualified purchaser status.
Whoa, okay. That is a big deal. Those are the rules that currently keep most people out of these complex investments, right?
That's right. They're based on wealth or income thresholds. Changing those could fundamentally alter who gets access. And it's worth noting the SEC chair, Paul Atkins, had already signaled some openness to changes like this earlier in 2025. So the groundwork seems to have been laid.
Okay, so the administration is clearly pushing hard for this expansion. But, like with any big change promising big returns, there have got to be questions, concerns, risks, especially with something as vital as retirement savings. What are the main downsides critics are pointing to?
Yeah, critics are definitely raising several significant red flags that could really impact your 401k. First and foremost, the issue of significantly higher costs and fees.
Okay. How high are we talking?
Well, think about private equity firms. They often charge management fees of maybe 2% of assets annually, plus a performance fee, often 20% of any profits above a certain level. And sometimes there are other less obvious portfolio company fees kind of buried in there.
Wow. Compare that to, say, a regular index fund.
Exactly. It's a stark contrast. A simple index fund might have an expense ratio as low as, 0.05% or maybe 0.20%. We're talking orders of magnitude difference. In fact, the SEC itself has noted that private equity's typical fee structure can consume potentially 25%, 50% of gross returns over time.
Wait, hold on. 25 to 50% of the gross returns before I even see a profit. That sounds enormous. How is that even justifiable?
Well, the argument from the proponents is that these fees are necessary to pay for the active management, the expertise needed to find and manage private deals, and that the potential for much higher returns justifies the cost. But critics argue that ultimately these higher costs just stem from the complexity of buying and running private companies, and those costs get passed straight to the investors, eating into your net returns. Then there's the whole issue of lack of transparency and illiquidity.
Or you mentioned illiquidity earlier.
Yeah. Alternative assets are often opaque. You don't get nice, clean, real-time price quotes like you do with stocks. Information can be limited, hard to get, valuations can be subjective, and they're highly illiquid. You often have to commit your money for, say, 5 to 10 years, maybe longer. You can't just decide to sell tomorrow if you need the cash. There are often strict penalties for trying to get out early.
So it's like locking your money away in a vault, and you don't get the key back for a decade. That doesn't sound great if, life happens and you need access to your retirement funds.
It definitely conflicts with the need for flexibility, especially as you get closer to or into retirement. And then performance itself is a major point of debate.
I thought the whole point was better performance.
That's the promise, yes.
Yeah.
Higher returns. But some analyses, when you dig into them, suggest the average private equity fund actually underperforms the S&P 500 by approximately 3% per year, net of fees.
Wow. Okay, that's actually shocking.
Yeah.
So despite all the hype and those incredibly high fees, the average outcome might be worse than just sticking with a simple, cheap index fund.
That's what some of the research indicates, yes. And critics also point to something called survivorship bias in a lot of the performance data that gets published.
Survivorship bias.
Yeah, that's where funds that failed, that went out of business, they just get dropped from the calculations. So the reported average returns look better than the reality experienced by investors across all funds, including the failures. Plus, there are huge performance gaps between the top-tier funds and the rest. Many mid-tier funds significantly underperform public market index funds once you factor in those hefty fees.
So unless you're getting into the absolute best funds, which presumably average folks won't.
Exactly. Which leads to the next point. The increased risk profiles, especially with things like cryptocurrencies, which we know can be incredibly volatile, swinging wildly day to day. These are generally considered high-risk, high-fee investments. And critics worry that a bad bet in these areas could potentially destroy a 401k balance in a way that a diversified stock fund is less likely to.
Okay, that's sobering. What else?
There's also a real knowledge gap and concern about this idea of mass market access. Critics argue that average 401k participants, regular people, they're unlikely to get access to the really good private equity deals. Those are often reserved for huge institutions, like endowments or sovereign wealth funds, people with deep pockets and connections.
Oh, we get the leftovers.
That's the fear, that individuals might just be funneled into mass market funds that have less transparency, maybe layered fees, or even worse, that 401ks could become an off-ramp for existing private investors.
An off-ramp, meaning?
Meaning a place for sophisticated private investors to sell their investments to 401k plans when they decide it's time to get out, potentially leaving the 401k participants holding assets that the smart money is already selling.
That does not sound ideal.
No. And finally, there are even broader societal concerns. You see discussions on platforms like Reddit, for instance, raising fears about a further concentration of wealth. What if these huge pools of 401k capital start buying up things like single-family homes, pushing prices even higher? Could it make home ownership even less feasible for average people? It's a potential unintended consequence.
Right. So a lot to unpack there. On one side, you have this promise of democratizing access, maybe getting higher returns. But the other side, the core insight, really seems to be you might be trading that potential upside for a whole lot more complexity, hidden costs, illiquidity, and maybe less control. It fundamentally challenges what we think of as a safe retirement account. That tension really stands out. So what does this all mean for you, the listener, and your retirement plans, particularly in the short term and the long term? What should you actually do about this?
Well, first, it's really important to understand that this executive order by itself does not usher in any immediate regulatory changes. It kicks off a process.
So nothing changes tomorrow in my 401k.
No, actual adoption by plans will likely be slow. It'll take months or even longer for the agencies like the DOL and SEC to issue new guidance. Then the big retirement plan companies need time to actually develop and vet appropriate funds. Realistically, it could even take several years before crypto and private equity become mainstream investments, readily available in the average 401k plan menu. This isn't an overnight revolution.
Okay, so there's time. How are these likely to show up when they do arrive?
For most participants, these alternative assets are expected to first appear not as standalone options you pick yourself, but as small components of professionally managed accounts or target date funds.
Ah, so bundled in with other stuff, managed by a pro.
Exactly. Think of it like this. Your plan fiduciary, the person or committee overseeing your plan, they still have that legal duty under ERISA to act prudently in your best interest. They'll be the gatekeepers. They'll have to carefully vet everything, the fund manager's track record, the fund strategy, its liquidity terms, how it values its assets, and, really crucially, those fee structures. This bundled approach allows for professional oversight to manage the risks and try to balance these higher-cost private assets with traditional low-cost index funds within a diversified portfolio. It's not meant to be a free-for-all.
So even with this order pushing for access, the fiduciaries, the plan sponsors, they still have a huge responsibility. Sounds like a lot of pressure on them and a lot of power.
It absolutely is, and it really highlights the essential role of financial advisors in helping guide their clients through this new, more complex landscape. Investor education is going to be crucial, and advisors themselves must act with a fiduciary's mindset, ensuring complete transparency, especially about any layered fees tucked away in these new structures. Some experts are even suggesting that maybe anyone investing in these alternatives within a 401k should have to be an accredited investor, meet those wealth or income thresholds just to make sure they truly understand and can absorb the higher risks involved.
Interesting. So maybe not for everyone, even if offered.
That's a distinct possibility. So the bottom line advice for savers right now remains pretty cautious. Generally, stick with solid investments. Things like low-cost index funds with global diversification. Understand that your 401k isn't protected from losses no matter what you invest in. And these alternative assets definitely come with potentially greater risk, less transparency, and higher costs. It becomes even more crucial than ever to seek guidance from a qualified financial advisor you trust. Make choices based on your own risk tolerance, your timeline, your goals.
Right. Just because your plan might offer these options down the road doesn't automatically mean they're the right fit for you.
Precisely. Don't feel pressured to jump in just because they become available. Choose wisely.
We've certainly covered a lot of ground today on President Trump's executive order and this push to expand 401k access to alternative assets. It's definitely a fascinating tension, isn't it, between that promise of democratizing wealth, getting everyone a shot at higher returns, and the inherent risks of these more complex, less transparent, often higher cost investments.
Yeah, this deep dive really shows us that the road ahead is, well, it's complex. It's about balancing financial innovation, which can be good, with consumer protection, which is essential for retirement security. And this executive order, it isn't just about what you can invest in, it kind of calls into question the very purpose of a retirement account in today's world. Is it meant to be primarily a stable, reliable vehicle for the long haul, built on traditional, transparent assets? Or is it becoming sort of a new frontier for Wall Street's latest products, maybe more complex strategies, higher fees? What stands out to you as you think about navigating this evolving landscape of retirement saving and figuring out how best to secure your own future?